Day trading techniques, tips and strategies. Copyright 2026 Anthony Jones, all rights reserved. Day trading techniques, tips and strategies. Dedication and purpose. This book is built from the lessons, scars, and breakthroughs I earned in the most volatile markets on earth. Every page comes from real trades, the wins that built my confidence and the losses that reshaped my discipline. Knowledge is power, but applied knowledge is transformation. My purpose is to give you both. I wrote this book so you don't repeat the mistakes that cost me time, money, and peace of mind. Lack of risk management, emotional trading, impatience, and revenge trading nearly destroyed my journey more than once. If I had a guide like this when I started, something. Day trading techniques, tips, and strategies. Honest, practical, and rooted in real experience. I would have saved myself years of stress and thousands of dollars. This book is your shortcut. Inside, you'll build a mindset capable of surviving and thriving in today's markets. You'll learn technical analysis, candlestick recognition, intraday setups, trending strategies, and risk management for stocks, crypto, options, and futures. You'll learn how to think like a trader, act like a trader, and grow like a trader. If you apply what's in these pages, you won't just improve your results. You'll evolve into a more disciplined, confident, and profitable version of yourself. Day trading techniques, tips, and strategies. Contents. Day trading techniques, tips, and strategies. Introduction. We live in an economy where inflation rises faster than wages, where the cost of living climbs while opportunities shrink. In a world like this, relying on a single income stream is a liability. Trading is one of the few skills that can change your financial trajectory. Not because it's easy, but because it's scalable, learnable, and yours forever once mastered. Trading can make you wealthy. Trading can also break you if you approach it without discipline. I learned this the hard way. I lost more money than I care to admit, not from market gains, but from my own life savings. Those losses pushed me into revenge trading, emotional decisions, and moments where I questioned everything. But I refused to quit. That determination was both my strength and my weakness. Looking back, every painful lesson had value. Every setback taught me something I needed to become the trader I am today. But I won't pretend it was easy. There were days I felt like I hit rock bottom, juggling bills, debt, and the mental weight of failure. Still, I kept going, and eventually, I rebuilt. This book is the blueprint I wish I had back then. The strategies inside aren't magic. They're not secrets. They're principles that work only when you apply them consistently. Trading success is a combination of psychology, discipline, and technical skill. When those three align, results follow. Your foundation begins with 3 rules. 2. Plan your trade. Define your risk and stick to the plan. The stock market offers opportunity, but it also demands respect. Prices rise and fall without warning. Volatility is the cost of potential reward. You can't eliminate risk, but you can manage it. You can't control the market, but you can control your decisions. This book will teach you how. Mindset, the first edge. Most traders lose because they enter the market with limited knowledge and unlimited emotion. They follow the crowd, chase hype, and react instead of prepare. Knowledge is your first defense. Understanding how markets move, how companies operate, and how price reacts to sentiment gives you an advantage most traders never develop. Research your trades. Understand the fundamentals. Study the technicals. Think long-term even when trading short-term. Past performance doesn't guarantee future profits. A stock that once soared can collapse. A company that once dominated can disappear. Your job is to evaluate the present, not worship the past. Use stop losses. Protect your capital. Trade with logic, not emotion. Diversify intelligently, not excessively. Hedge when necessary. And above all, keep learning. Markets evolve. Strategies evolve. Traders must evolve too. Chapter 1, Mindset Tips. Plan your trade. Define your risk. Stick to the plan. Market come with risks attached. You cannot get good returns without undertaking the volatility risks associated with stock price movements. Stock prices are subject to fluctuations, and these are a part and parcel of the stock market. While the price might increase attractively in a bullish market, the same may plummet the next day. So, while you are earning, Stock market investing is synonymous with attractive and quick gains and capital appreciation. However, the returns offered by the stock returns one moment, you might incur losses in the next moment as the value of your stock holding falls. So what should you do? Should you not invest in the stock market altogether? Though the stock market is a risky avenue, there are ways in which you can avoid losses. You don't have to abstain from stock trading or stock investing. You just need to be a little wise when it comes to investing in the stock market. Here are some tips which, when followed, would allow you to avoid making considerable losses in the stock market. Mindset tips to avoid losses in the stock market. Learn about the market. Knowledge is power. One of the many reasons why many investors suffer losses in the stock market is because they start their investments with limited or no knowledge. The stock market is a trading marketplace, and unless you know the ins and outs of the domain, you will incur losses. A little knowledge is a dangerous thing, isn't it? Equip yourself with the knowledge of how the market works. Learn the pricing techniques of stocks so that you can anticipate which stock would make a profit and which might suffer a loss. Also, the stock market and the economy of the country are interlinked. If one moves up, the other will follow. Even if the stock market falls, if the economy is strong, the market would rise so that you can remain invested. When you approach stock investing with complete knowledge, you can avoid making rookie mistakes that incur losses. Learn about the stock market, and then jump on the investor bandwagon. Research the stock you pick. Do you follow the herd mentality when investing? If you do, it's time you give up the habit. Don't pick stocks only because they are popular with other investors. Research the stock before investing in it. Find out the company's financial position, fundamentals, projected cash flows, market capitalization, market sentiments around the stock, and prospects. If the company is poised to grow and has strong fundamentals, its stock would not give you losses. When investing, either pick already established companies to avoid a possible downturn or those you have researched into. You can take the help of your broker to do your research, but always make an informed choice. Have a long-term perspective. While it is true that stock investing has the potential of quick returns, you should invest with a long-term perspective. There is no quick-fix formula for returns in stock investing. You can ride on the market wave and make quick bucks when the market is rising, but always think long-term for stable returns. Long-term investing reduces the risk associated with stock trading. Moreover, even after a crash, the stock market always rebounds and gives positive growth. You just need to give it time. For example, the S&P 500 crashed at the beginning of COVID and rebounded more than the price it was trading at before the pandemic. This is why long-term investment is the key word to avoid losses in stock investing. Even if your stock's value falls, you can remain invested and wait for the value to bounce back and grow so that you can earn positive returns. If you have a myopic vision, losses would be impossible to avoid. Past performance does not guarantee future profits. Another common mistake that many investors make is to rely on stocks' past performance when selecting them. Then for investment, past performances can never give you the projected future return. For example, the stock of Jet Airways or Videocon had a good track record for many years before the company went bankrupt. Had you invested in these stocks based on their performance, your investments would have been useless after these companies faced bankruptcy. Historical performance does not guarantee future profits. You should assess the financial fundamentals and have a good understanding of the market the company operates in before investing in it. Study the company's price-earnings ratio, which would help you understand whether the stock is undervalued or overvalued. Investing in undervalued stocks would yield profits, while overvalued ones may not have great potential for profits. Moreover, a company with a strong history of profitability would be financially healthy compared to companies that have not yet generated revenues. So, stock assessment on financial aspects is essential. This assessment would help you understand whether the company is under stress or not, and then you can make the right choice of investment. Stop loss can work wonders. When it comes to profits from stock investing, the sky's the limit. On the other hand, the losses can run into the ground. One way to minimize your losses is to use the stop-loss tactic. Under this tactic, you instruct the broker to sell the stock when it reaches a particular price level, called the stop-loss level. This is significant when the stock prices are falling. By selling off at the stop loss point, you can prevent further degradation of returns if the prices fall further. For example, say the stock price is at 1,500, and then it starts falling. You expect a further fall in the stock price, and you put a stop loss order at 1,350. Now, if the stock price reaches 1,350, the broker would sell off the stock so that you can avoid losses in case of further devaluation. On the contrary, if the stock price starts rising, you don't have to worry because stop loss doesn't limit your profits, only your losses. Use the stop loss strategy when prices are falling. Estimate the minimum price at which you can sell the stock and still make a profit. Set this price as the stop loss price so that you can avoid losses when the price falls further. Leave your emotions at home when you set out to trade in stocks. How many times have you let your emotions dominate your investing strategy? When it comes to stock investing, practicality matters, not emotions. If you let your emotions dictate your trading activities, you would eventually face a loss. So, when you are buying and selling stock, be practical and keep a cool head. Remember, upturns and downturns don't last lifelong. If the market is bullish, it will enter the bear phase after some time. And if the market is bearish, it would rise and become bullish. The stock market is a roller coaster ride with both profits and losses. To avoid losses, you need to be clear-headed about your investments. If the market is rallying, rein in your emotions of investing all your wealth. Go slow. Similarly, when the market falls or enters a downward phase, don't get emotional and sell off your stock immediately. Be calm and taking your time. When the market is rising, invest slowly and carefully. Similarly, when the market is falling, don't liquidate your investments. Hold on to them as the market would recover. Emotions might let you make the wrong decisions about buying and selling stock. But when you are practical, you can carefully weigh the pros and cons of the market dynamics and then invest with caution. Diversification is the name of the game. Have you ever heard the saying, don't put all your eggs in one basket? If you have, do you understand its meaning? When you put your eggs in different baskets, if one basket gets damaged or if one egg is bad, you still have other baskets to fall back on. The same holds for stock investing. Diversification should be the mantra for successful investing. Choosing a variety of stocks is vital in preventing losses. If one stock suffers a loss, the other might not, thereby decrease the risk of losses. For example, say you buy two stocks A and B worth 100 each. Now, if the price of A moves down to 95 and the price of B rises to 105, your losses are even though you have invested in stock A. The profit from stock nil B has nullified your loss. Though stock trading is not as simple, diversification plays the same role. You should pick stocks of companies belonging to different sectors. This way, if one industry underperforms, your losses would be minimized due to the growth in other sectors. The latest example of diversification one can see in the COVID pandemic. When the pandemic struck, the stock market started sliding due to lockdowns and uncertainty that affected the industry. Stocks of manufacturing companies started falling, but stocks of pharmaceuticals were on the rise. So, investors with investments in different sectors managed to earn profits despite the falling markets because they had exposure in the pharma and FMCG sectors, giving them the best effect of diversification. So, aim for a diversified portfolio of stocks. Invest in different sectors for maximizing profits and minimizing losses. Also, don't overdo diversification. Excess of everything is terrible, and the same is true for diversification. A highly diluted portfolio would fail to give you significant returns from a performing sector. There might even be higher chances of loss, so diversify, but with reason. Hedge against losses. Hedging is also a useful tool that can help you prevent losses from stock investing. Hedging means cutting down losses from one investment by investing in another. Hedging in the stock market can be done through futures and options contracts or call or put actions. Similarly, when the market is falling, you can hedge your losses. Investments by investing in alternative avenues, like gold. Gold tends to rise when the markets are unstable. This was observed both at the time of demonetization and the COVID pandemic when the markets were in turmoil, but gold prices rose. so you can use gold or other investment avenues or trade in futures and options to hedge against equity investments. Keep learning. Learning is a never-ending process. And when it comes to the stock market, new rules and regulations are always being updated. Therefore, you should update yourself with the latest changes in the market and the companies comprising the market. Also, master the art of stock investing for an in-depth understanding of the market and how it works. Take online courses, read books on stock trading, understand the strategies of successful investors, and expand your knowledge base. Also, keep track of current affairs that can help you understand which company is poised to grow to invest in it and grow your investments. You have to be able to adapt. Mindset 101. Markets can change rapidly. Be prepared to adapt your strategy based on changing market conditions and new information. Today's volatile market can definitely be confusing at times. The market can stay irrational longer than you can remain solvent. At times, what does not make sense will inevitably happen. Always have no bias and a trading plan for both ways, and pay attention to price levels, that is support and resistance, RSI, overbought and oversold, also the volume on the day chart. Patience plus strategy equal to gratification. Use AI for assistance in analyzing charts. Take a screenshot of your chart and upload it to ChatGPT, Copilot, or Gemini. When asking for a breakdown, be precise about what you want to analyze, such as price action, support resistance levels, candlestick patterns, or premium behavior. The more specific your request, the more tailored and useful the AI's response will be. Trend and market structure. Is the overall trend bullish, bearish, or range-bound? What time frame trend matters most right now? Are we making higher highs, lows, or lower highs, lows? Is price extended or still early in the trend? Support and resistance. Where are the key support and resistance levels? Which level is most likely to break next? Is this consolidation, distribution, or accumulation? Are we near a major daily, weekly level? Indicators and confirmation. Are indicators confirming or diverging? Is RSI showing overbought, oversold, or divergence? Is price respecting VWAP or key moving averages? Is momentum increasing or fading? Candlestick and price action. What does the most recent candle suggest? Is this a breakout, fake out, or rejection? Do you see reversal patterns? Is volume confirming this move? Trade planning. What is the high probability bias, long or short? Where is a safe entry, stop loss, and target? What would invalidate this setup? Is this better suited for a scalp, day trade, or swing trade? Is the risk to reward worth taking? Context and probability. Is this move driven by news, earnings, or pure technicals? How does this chart look compared to the broader market? Is this stock leading or lagging its sector? What are the most likely scenarios for tomorrow? Risk and caution. What are the biggest risks on this chart? Where could traders get trapped? Is this a late entry or early opportunity? Would patience be better than action here? Pro tip: instead of asking, should I go long or short? Ask, what's the best trade idea? Where is it wrong, and what confirms it? You can pretty much ask AI anything related to trading, and it will give informative suggestions from real market data. Chapter 2. Good Trader Characteristics. Becoming a consistently profitable trader isn't about finding the perfect strategy. It is about becoming the kind of person who can execute one. The market rewards discipline, patience, and adaptability. It punishes ego, impulsiveness, and emotional attachment. The characteristics below form the foundation of every successful trader, regardless of their style or market. Flexibility, adapt or get left behind. The market is dynamic. Trends shift, volatility changes, and sentiment flips without warning. A good trader stays flexible, willing to adjust positions or exit entirely when new information appears. Holding onto a trade because you believe in it is emotional trading. Holding onto a trade because the data supports it is professional trading. Adaptability is survival. Risk management. Protect your capital first. Emotional attachment blinds traders to risk. Pride convinces you to hold a little longer. Hope whispers that the trade will turn around. But the market doesn't reward hope, it rewards discipline. A good trader cuts losses quickly, respects stop-loss levels, sizes positions responsibly, and never risks more than they can emotionally tolerate. Your capital is your ammunition. Protect it like your life depends on it. Learning from mistakes, the fastest path to growth. Every trader makes mistakes. The difference between amateurs and professionals is how they respond. A losing trade isn't failure. Refusing to learn from it is. When you detach emotionally, you can analyze. Objectively, what went wrong? Was the setup valid? Did I follow my rules? Was the loss avoidable or part of the game? Your mistakes are tuition. Pay attention so you don't pay twice. Focus on the positive. Mindset shapes performance. Your thoughts influence your decisions. Negative thinking leads to hesitation, fear, and self-sabotage. Positive reinforcement builds confidence and clarity. Replace negative thoughts with affirmations that support discipline and growth. A strong mindset keeps you steady when the market becomes chaotic. Taking breaks resets your mind to see clearly. Constant exposure to charts, news, and price movement can overload your brain. Stepping away helps you reset, regain perspective, and avoid emotional decisions. A clear mind sees opportunities. A stressed mind sees threats. Breaks are part of the process, not a sign of weakness. Journal your trades. Turn data into wisdom. A trading journal is one of the most powerful tools you can use. Document your entries, exits, reasoning, emotions, mistakes, and improvements. Patterns will emerge, both good and bad. Journaling turns randomness into structure and structure into mastery. Meditation, training your mind like an athlete. More traders are adopting meditation because it strengthens awareness, emotional control, patience, clarity, and discipline. A calm mind makes rational decisions. A chaotic mind makes expensive ones. Follow your rules. Consistency creates results. Green or red, if you followed your rules today, you won. The market transfers money from the impatient to the patient. Your rules exist to protect you from yourself. When you follow them, you re-trading like a professional. When you break them, you re-gambling. There is no perfect system, only a system that fits you. Many traders waste years searching for the holy grail. It doesn't exist. Instead, build a system that is comfortable, repeatable, emotionally manageable, and technically sound. A system you can follow is more powerful than a system that looks perfect on paper. Winning isn't about perfection, it is about consistency. Admit when you're wrong and reanalyze. The market doesn't care about your ego. When a trade is invalid, cut it. When your analysis changes, adapt. When your plan is broken, exit. Your job is not to be right. It is to protect your capital. Sometimes you'll catch them, but that doesn't make you a better trader. It just means probability favored you in that moment. Waiting for perfection often causes you to miss great trades. If you trade, Instagram, no limit trading. Stop chasing perfect entries. Trade the plan. There is no perfect way to time the exact bottom or top. Options, especially Zerati. Remember, theta decay is brutal. Your target may hit the next day, and giving your trade more time often improves outcomes. Trade your plan, not your fantasies. Chapter 3. Market Structure. Market structure is the backbone of price action trading. It reveals the story behind price movement and helps traders understand where the market is coming from, where it is now, and where it may go next. Mastering market structure is essential for anyone serious about trading. Uptrends and downtrends, the market's language. In an uptrend, highs move higher, lows move higher, and momentum favors buyers. In a downtrend, highs move lower, lows move lower, and momentum favors sellers. Your job is to identify when structure shifts, because structure shifts often precede trend reversals. Key principles to remember. Market structure helps you identify chart patterns like triangles, flags, head and shoulders, and double tops/bottoms. Price respects support and resistance until it doesn't. Then it moves to the next level. Structure helps traders spot reversals, continuations, and consolidation zones. Both beginners and advanced traders rely on structure because it simplifies the chaos. Identifying breakouts. When price escapes the range, a breakout occurs when price moves beyond a key level with strength. Breakouts often signal the start of a new trend, but false breakouts are common. To improve accuracy, look for volume confirmation, trend line breaks, and retests. Always use stop losses. Breakouts can fail. Your job is to survive the failures and capitalize on the real moves. Always hedge. Manage uncertainty. Trading rules, tips, and common mistakes. Trade only in liquid stocks if your stop loss keeps getting hit. Stop trading and reassess. Never revenge trade if your first trade hits your weekly target. Stop trading for the day. Always use a stop loss. Never move it. Never average down into a losing position. Don't trade without a valid signal and set up enter only when all criteria are met. Aim for a minimum 1-to-1. 5. Risk reward. Never put all your capital into one trade. Don't trade with investment funds. Never borrow money to trade. Avoid greed. Take what the market gives you. Don't overload your chart with indicators. Don't follow random trading calls or signals. Backtest your strategy before risking money. Trade only 1 to 2 stocks at a time for option buying. Avoid OTM. Stick to ITM or ATM as a beginner. Take only 1 trade per day with a fixed stop loss. Protect capital before thinking about profits. Cut losses fast and ride winners. Keep position sizes small. Avoid trading in choppy markets. Avoid stocks heavily influenced by news. The probabilistic mindset. A professional trader operates from 5 truths. Anything can happen. You don't need to know what happens next to make money. Wins and losses are randomly distributed, and edge is simply a higher probability of one thing over another. Every moment in the market is unique. To become a consistent winner, a trader must believe. I identify my edges objectively. I predefine the risk on every trade. I fully accept the risk. I act on my edges without hesitation. I pay myself when the market offers profit. I monitor my emotional susceptibility to errors. I never violate the principles of consistency. Trading skills of a professional. Professionals evolve beyond typical errors, not defining risk before entering, refusing to take a loss, letting it grow, letting winners turn into losers, moving stops too close and getting shaken out. What separates pros from amateurs? They plan their trades, they execute without hesitation, they move in and out of trades effortlessly. Components of consistency. A clear trading plan, defined risk parameters, position sizing rules, profit objectives, realistic expectations, advice versus reality. Start investing now or you'll be broke. Act promptly, but don't rush. You need a lot of money to start. Small capital is enough. Follow what others are buying. Hype is dangerous. Do your own research. Investing is all about news and trends. Systems and risk management matter more. Mindset 101. Risk management is everything. There are no shortcuts, only consistency and discipline. This is a game of patience. Small profits compound into big results. 0-day options and SPX tactics. Trade only true intrinsic value options. Always hedge. Use protective calls. Puts near the close. Buy SPX contracts at true value during consolidation. Use resistance for puts and support for calls. Trade only overreactions. Buy support. Short resistance. Wait for the best setups. 1 to 2 trades per week is enough. If your target hits once, don't expect it to hit again. If a losing trade comes back to Bragavin, exit. Use buy and sell limits. Chapter 4. Technical patterns and market tools. Technical analysis is the language of the market. The more fluent you become, the more confidently you can identify opportunities, manage risk, and anticipate price behavior. This chapter breaks down essential tools and patterns every trader should master. From price channels to RSI, from pullbacks to supply and demand. Price channels, the market's pathways. Price channels show how an asset moves between 2 parallel boundaries, the upper boundary, the lower boundary, and the space between. When price oscillates inside this structure, the market is range-bound. Channels help traders identify high-probability entries, exits, and trend continuation or reversal points. Key principles. Channels work best in trending markets. Sideways markets can produce noise. Confirm channel signals with indicators like RSI, MACD, or moving averages. Always check multiple time frames to validate structure. Take profits near the upper boundary in an up channel, near the lower boundary in a down channel. Trading volume, the market's voice. Volume measures how many shares or contracts were traded in a given period. It reveals conviction behind price movement. How to use volume. Rising price plus rising volume equal to strong uptrend. Falling price plus rising volume equal to strong downtrend. Sudden volume spikes can signal reversals. Combine volume with indicators for confirmation. Hammer candlestick. A signal of buyer strength. A hammer forms when price drops significantly, but buyers push it back near the open. It looks like a T. Long lower wick. Small body. Keynotes. Appears on all time frames, requires confirmation from the next candle, signals potential reversal only after confirmation. The death cross, A shift in momentum. The death cross occurs when the 50-day moving average crosses below the 200-day moving average. Despite the dramatic name, it often signals short-term recovery after initial weakness. What it means: selling pressure has increased. Market sentiment is bearish. The 200-day MA becomes major resistance. Short sellers may use the cross to set stop levels. Trading pullbacks. Buying the dip with intention. A pullback is a temporary dip in an uptrend. It's one of the safest and most reliable entry strategies. How to trade pullbacks. Identify support levels. Wait for confirmation. Don't jump in early. Watch volume. Low volume equal to healthy pullback. Be patient. Not every dip is a pullback. Never chase. Let the market come to you. Trailing stop loss. Protecting profits automatically. A trailing stop moves with price as it rises, locking in gains while protecting you from reversals. What to remember: market makers can hunt visible stop levels. Setting stops too tight can trigger premature exits. Trailing stops work across stocks, options, and futures. Supply and demand. The market's power zones. Supply zones equal to where sellers dominate. Demand zones equal to where buyers dominate. Price. React strongly to these areas. Tips for using supply and demand. Repeated tests weaken zones. Narrow zones often produce stronger reactions. Adjust profit targets based on market conditions. Too many wicks or choppy action can invalidate a zone. Head and shoulders, a reliable reversal pattern. This pattern signals a shift from bullish to bearish momentum. Trading tips. Wait for the neckline break. Confirmation is essential. Traders trapped in the right shoulder often accelerate the move. Targets aren't always hit. Adapt exits to conditions. Patterns aren't perfect. Expect variations. RSI indicator. Momentum meets opportunity. RSI measures the speed and magnitude of price changes. Above 70 equal to overbought. Below 30 equal to oversold. Advanced RSI tips. In uptrends, RSI dropping below 50 can be a long entry signal. Look for bullish or bearish divergence. Combine RSI with patterns or support resistance. Double bottom. A strong support reversal. A double bottom forms after a downtrend and signals potential reversal. Pattern breakdown. First bottom, temporary rebound. Second bottom, stronger buying pressure. Neckline break, confirmation of trend reversal. ABCD pattern, harmonic precision. The ABCD pattern identifies potential reversal points using Fibonacci ratios. Structure: AB, strong move. B, C, retracement. CD, move equal to a BD, reversal zone. Important strategic notes: tactical execution protocol. Pay attention to in-the-money options premium prices and the time of day, especially the end of the day. Count 6 in-the-money strikes from the previous closing price and wait to enter until the premium cools. Already pre-calculate your premium entry price and know your exit target before entering the trade. Do not trade unless you have an analytical plan before placing the trade. Come up with a strategic plan of different scenarios before the market opens based on futures, pre-market data, and structure. Stop taking blind trades. Only trade in the money options that lose intrinsic value. Only execute trades on significant levels of interest. Pay attention to the price of the options premium. It will tell you a lot, especially into the market close. Use mathematics to calculate the actual premium price of high and low targets. Must take profit if your contract goes from out of the money to in the money into the close. Have sell limits ready. The price can reverse in less than 30 seconds. Trade as if you only have $100 to trade with. Look for the lowest, best item option price. Pay attention to your options premium price. Track it. If the trade is losing value, know the lowest price and calculate your exit. Example, enter at 10, drops to 2. Exit target should be 6. Only buy out of the money call or put options when you see a clean breakout or breakdown. Take profit quickly for a scalp. Contracts may go from 100 to 200 then collapse and never return. When in a choppy market, be a scalping pro, in and out. Take what the market offers. 1. Preserve account balance. 2. Row account balance. If dumping into market close during the last 10 minutes, buy puts. If squeezing up, buy calls. Do not go against the trend. Only buy SPX options at the end of the day that were worth over $5,000 at the high of the day. Never buy options that maxed at $2,000. They lack range. Pay attention to options premium price on the day. They often move in a 1-to-3 ratio. Example, low of day premium equal to 100, high of day approximately equal to 300, unless it has a strong trending day. If the market is choppy and trading in a range, only buy support or short resistance. Set take profit zones and execute. Tip, when looking to purchase a call or put into the market close, look for the highest. Open interest on the ATM put and ATM call. From now on, every trade must have at least 3 key reasons for entering, including take profit level and hedge, especially into the close. Have notes prepared. Write out your trading plan, key support and resistance, pre-market high and low, VWAP, update levels as the day proceeds. Track options premium at the low of the day and high of the day. Chapter 5, Advice versus Reality, the Trader's Truth. The trading world is full of advice, some helpful, some misleading, and some dangerous. New traders often get caught between what people say and what actually happens in the market. This chapter cuts through the noise and gives you the truth, the reality behind the cliches, the mindset behind the strategy, and the discipline behind consistent results. Common advice versus reality. Advice: start investing now or you'll be broke. Reality: act promptly, but don't rush. Bad decisions made in panic can cost far more than waiting for the right opportunity. Advice: you need a lot of money to start investing. Reality: capital helps, but consistency matters more. Small accounts grow through discipline, not size. Advice: buy what everyone else is buying. Reality: hype is not a strategy. Most popular picks online are driven by excitement, not analysis. Do your own research. Advice: just follow the news and trends. Reality: news is noise without a system. Smart traders use structure, rules, and calculated risk, not headlines. Protecting your capital the first priority. Risk management is not optional. It is the foundation of survival. Learn it, practice it, implement it. Mindset 101. Consistency, discipline, and a trained mind beat shortcuts every time. The game of patience, small profits compound into big results. Consistency is the key that unlocks longevity. 0-day options and hedging principles. Only trade true intrinsic value on 0DT. Always hedge your position. Example, if you buy a 4,490 put for $500 near market close, hedge with a 4,485 call for $30. If the market reverses, the hedge protects your capital. The ultimate strategy. On days when SPY moves 4+ points, look for SPX contracts that were $150 plus at the low. Into the close, premium often returns to true value. At the 10-minute close, set buy orders at highest resistance for puts and lowest support for calls. Always analyze both directions. Poor trading principles. Only trade overreactions. Buy support, short resistance. Observe until opportunity appears. Use sell limits. Always hedge. Larger gaps equal to stronger continuation probability. If your target hits once, don't expect a second hit after a pullback. If a losing trade recovers from 6 greater than 3, greater than 10 exit. Trade once or twice per week if needed. If your option won't break support resistance into the close, hedge it. Trade planning. The non-negotiables. Before entering any trade, you must know 1. Conditions 2. Time frames 3. Targets and stop losses 4. Position size 5. How you will manage the trade. Always check volume. More than average equal to strong confirmation. Less than average equal to weak confirmation. Check your chart for support, 5-day chart for resistance. Follow your plan. Trust your process. Trade types. 1. Scalps. Fast entries. Fast exits. 2. Trend trades / day trades hold longer to capture a larger directional move. There are only 2 reasons to exit a trade. 1. Your target hits. 2. Your stop loss triggers. Price levels to mark daily. Pre-market high. Pre-market low. Previous day high. Previous day low. Stop being afraid to lose. Fear makes you focus on risk instead of reward. How to eliminate fear. 1. Have a proven strategy. 2. Remove guessing. 3. Accept losing as part of winning. 4. Focus on 3-to-1 risk reward. 5. Give trades room to breathe. Trade the trend. Strong green candles on the 5-minute equal to ride the move. Avoid choppy price action. Stick to high probability setups. Oversold at 2-week support often rallies. Overbought at resistance often drops. Hot sectors rotate every 2 to 3 days. Mindset and performance. Before trading, ask yourself, is my mind in the right state to trade today? You cannot control outcomes. Trade what you see, not what you think. Think in probabilities. Avoid emotional pain. It clouds judgment. Be a sniper, not a machine gunner. Discipline of a ruler. Courage of a warrior. Comfort in discomfort. Focus on performance, not outcome. Stay present. Don't be hypnotized by price. Think clearly. Avoid indecision. Build a mind that performs under uncertainty. I am not my thoughts. Tearing in and out. Start small. Scale in as the trade proves itself. Take profits at targets. Tear out to lock gains. Cut losers quickly. No hope. Only conviction. Macro plus technical checklist. Macro. Rates. Inflation. Bond yields. Dollar strength. Supply chain. News. Geopolitical risk. Fundamentals. Company strength. Tariff catalyst. Market cap. Relative strength. Technical. Key levels. RSI. MACD. Volume. Trend. VWAP. Support resistance on multiple time frames. Know your levels in advance. Limit orders equal to discipline. Market orders equal to emotion. Let the market come to you. The 2-step entry process. 1. Identify levels. Supply and demand. Key support. Resistance. 2. React at the level. Watch buyers, sellers. Tape reading. Volume. Related markets. Candlestick confirmation. Without both steps, there is no trade. Chapter 6. Have a plan and know your sell targets. Successful trading is not about predicting the future. It's about preparing for it. A trader with a plan is steady, patient, and intentional. A trader without a plan is emotional, reactive, and inconsistent. This chapter teaches how to build a trading plan, follow it, and manage trades with clarity and confidence. 1. Why every trader needs a plan. A trading plan answers 2 essential questions. When do I get in? When do I get out? Your system doesn't need to be perfect. It needs to be consistent. If it stops working, adjust it. If the trade invalidates, exit. If a better opportunity appears, take it. A plan protects you from emotional decisions and keeps you aligned with long-term goals. 2. Entry logic and confirmation. DD bar. Buy the dip or buy the rip. Applies to consolidating stocks. Wait for confirmation. Oversold. On the 4-hour suggests a rebound. Overextended on the 30-minute or daily suggests a pullback. Always check multiple time frames. Watch gap fills, bull-bear flags, and use ES futures to track SPY. 3. The trade planning checklist. 2. Build your system on facts, not opinions. Before entering any trade, ask, is this aligned with my risk rules? Does it fit my plan? Do I know my entry trigger? Do I know where I will exit if wrong? Are fundamentals supportive? Do I have an in-trade management plan? Am I confident and clear? Beginners should start with shares or paper trading. 4. Trading rules and principles. 1. System must produce big wins and small losses. 3. Look for low risk, high reward setups. 4. Identify the trend by time frame. 5. Start with weekly, daily, hourly. 6. Support resistance strengthens with tests until it breaks. 7. Moving averages quantify trends. 8. Bull markets have no long-term resistance. Bear markets have no long-term support. 9. Large gaps increase continuation odds. 10. Last hour reveals true trend strength. 11. Above 200-day MA is bullish, below is bearish. 12. Focus on a few stocks. 13. First sharp dip finds buyers. First big rip finds sellers. 14. Reversals build slowly. 15. Best trades work quickly. 16. Hope is not a strategy. 5. Key levels, indicators, and tools. Look left for major support, resistance. Use MACD, RSI, VPVR, CCI, and momentum channels. Use Fibonacci retracement. High volume equal to conviction. Low volume equal to weak setup. Watch psychological levels. 6. Execution discipline. Set price alerts. Tier into trades. Use sell limits. If there is no trigger, there is no trade. Sometimes the best trade is no trade. Trade the chart, not the headlines. 7. Compounding and small gain strategy. Small, consistent gains compound into meaningful growth. 10 to 20% gains are safer than chasing 80%. Most options expire. Worthless selling premium can generate income. Think like a casino, one through probability over time. 8. Market behavior in special situations. Fridays and 0DT. After 3 p.m., contracts decay rapidly. If up 250 to 300%, take profits. Consolidation of 6+ days leads to strong breakouts. Gap down days offer cheap entries but require discipline. Above VWAP is bullish. Below is bearish. Trade where open. Interest is concentrated. Overreactions often lead to reversals. 9. Mindset and emotional control. Never have too much conviction. Hedge or play both sides if uncertain. Pause before entering. Avoid overthinking. Chasing, FOMO, and bias. Use stop losses daily. Take tester positions. Get 4 to 5 confirmations. Master one stock first. Only trade catalysts. Paper trade to build skill. Don't trade money you need. Don't overtrade. Meditation helps. 10. Risk management and position sizing. Hedge when uncertain. Risk 1 to 5% per trade. Cut losing trades quickly. Protect capital above all else. 11. Common beginner mistakes. Holding losers out of hope. Thinking trading is get rich quick. Overtrading. Chasing. Trading without a plan. Ignoring volume. Letting emotions override rules. If price, volume, and your gut say the trade is invalid, exit and reassess. 12. The trader's commitment. I will not hold and hope. I will exit when support breaks. I will wait for confirmation. I will follow my rules. I will protect my capital. I will trade with patience. I will think in probabilities. I will trade the chart, not my emotions. I will plan my trade, define my risk, and stick to my plan. Chapter 7. The psychological mindset of a consistent trader. Trading is not just a technical skill, it is a psychological discipline. Charts, indicators, and strategies matter, but your mindset determines whether you follow your rules, manage risk, and stay consistent. This chapter teaches the mental framework required to trade with clarity, discipline, and emotional control. 1. The foundation of trading psychology. Successful traders understand themselves as deeply as they understand the market. Your strengths, weaknesses, habits, and emotional tendencies shape every decision you make. Core psychological skills include knowing your strengths, recognizing your weaknesses, developing confidence, becoming self-aware, knowing when to take a break, learning to adapt, controlling your environment, managing stress, identifying your emotions, building a routine, and challenging your assumptions. You cannot control the market, but you can control your mind, your actions, and your response to uncertainty. 2. The trader's attitude. Never assume you know what the market will do. Start each day with a positive, neutral, open-minded attitude. Do not predict, react, do not force. Observe. Do not assume, confirm. Do not cling, adjust. Have no bias. Remain objective. Let the market show its hand. When you see a familiar pattern, you execute calmly, mechanically, without hesitation. 3. Discipline, the core skill. Discipline is the ability to follow your rules even when your emotions want to do something else. Without discipline, emotions control you, leading to chasing, hesitation, overtrading, holding losers, and breaking rules. With discipline, you act in your best interests, follow your system, stay consistent, and protect your capital. Your daily decisions compound, they create your future as a trader. 4. Staying present. The present moment is where clarity lives. When you are fully present, you see the chart clearly, react appropriately, avoid emotional impulses, and feel calm and grounded. Happiness, confidence, and control all come from being here, not in the past or future. The market only exists now. Your job is to meet it where it is. 5. Consistency over time. Success is not a single event, it is a process. You will fail, win, learn, and grow. Consistency is built through repetition, reflection, and discipline. A big win can inflate your ego, A big loss can paralyze you. Stay humble. Stay open-minded. Stay grounded. 6. Understanding fear, greed, and overconfidence. Fear makes you exit winners too early or hold losers too long. Greed makes you oversize and ignore risk. Overconfidence makes you break rules and assume you're right. Your job is to recognize these emotions early and neutralize them with discipline. 7. Thinking in probabilities. The market is uncertain always. You never know what will happen next, but you can identify high probability setups, manage risk, accept uncertainty, and react to what the chart shows. A professional trader thinks in probabilities, not predictions. 8. The 3 development stages of a trader. The mechanical stage, you follow strict rules, execute predefined setups, remove emotion, and build consistency. The subjective stage, you understand price movement, adapt to context, and refine your edge. The intuitive stage, you trade in the zone, feel the flow of the market, and react with confidence and clarity. This is the black belt level of trading psychology. 9. Principles of consistency. 1. Objectively define your edge. 2. Predefine the risk of every trade. 3. Fully accept the risk. 4. Act on your edge without hesitation. 5. Pay yourself as the market offers profit. 6. Monitor your emotional tendencies. 7. Never violate your principles. 10. Managing stress and mental fatigue. Trading is mentally demanding. To perform well, you must take care of your mind and body. Sleep well, eat clean, exercise, meditate, prepare mentally, and avoid trading when emotionally unstable. Your mental state directly affects your performance. 11. Avoiding psychological traps. Do not revenge trade. Do not be reckless. Do not trade your opinions. Do not ignore volume. Do not hold losing trades out of hope. Do not let fear blind you. Do not get stuck in past mistakes. Every moment in the market is unique. React to what is happening, not what you wish would happen. 12. Building a professional trader identity. Treat trading like a business. You are the CEO. Your decisions determine your profit and loss. Observe yourself. Analyze your behavior. Review your trades. Study your mistakes and improve your process. Professional traders are not perfect. They are self-aware. 13. Daily mental habits and routines. Start with a clear mind. Review your rules. Set your intentions. Stay patient. Wait for confirmation. Take profits at targets. Cut losses quickly. Journal your emotions. Reflect after the session. These habits build long-term success. 14. The trader's psychological oath. I trade the chart, not my emotions. I stay present and focused. I accept uncertainty. Follow my rules. I trust my strategy. I cut losses quickly. I take profits at targets. I stay disciplined. I think in probabilities. I remain humble. I improve every day. Chapter 8, Risk Management. The discipline, structure, and mindset that protect your capital and keep you in the game. Risk management is the foundation of every successful trader. It's the quiet skill that never gets enough attention, yet it determines whether you survive long enough to grow. Most traders obsess over entries. Professionals obsess over risk. The market is a random environment. Anything can happen at any moment. Because the market has no structure, you must become your own structure, your rules, your discipline, and your risk. Framework are what keep you grounded when price action becomes chaotic. This chapter teaches you how to think in probabilities, manage uncertainty, control your emotions, and protect your capital so you can trade another day. The core principles of risk. Focus on risk, not entries. Trade only setups with proper risk to reward. Use position sizing that protects your account. Cut losers quickly and without hesitation. Follow your plan, not your feelings. Stay consistent with your rules. Think in probabilities, not predictions. Your job is not to predict the market. Your job is to manage risk inside a probabilistic environment. The market is random, your rules are not. The market doesn't owe you structure. It doesn't care about your conviction, your feelings, or your expectations. It moves based on liquidity, volume, catalysts, and the behavior of millions of participants. Because of that, you must accept full responsibility for every trade. Be your own structure. Implement and apply your rules consistently. When you stop trying to control the market and start controlling yourself, your trading transforms. Think in probabilities. Trading is a business built on probabilities, not certainties. When you understand this, you stop forcing trades and start managing outcomes. Position sizing, your first line of defense. Position size determines survival. Most traders blow up not because of bad setups, but because of oversized entries. Have a plan before you enter. Never enter a trade without knowing your entry, stop loss, take profit target, and hedge. Cut losers quickly, learn how to lose properly. Exit losing trades early. Protect capital so you can trade another day. Let winners run. Trim at targets. Re-enter at support if the trend continues. Scale out to create a risk-free position. Reading price, volume, and trend. Risk management is not just emotional discipline, it's technical awareness. Know your risk tolerance. Only risk what you can emotionally handle. Oversized positions trigger emotional trading. Why traders fail? Most traders fail because of behavior, not strategy. The mental side of risk, your mindset determines your outcomes. Patience, emotional control, and reacting to the market, not predicting it, are essential. The trend is your friend. Never fight the trend. Respect catalysts. Trade high-volume stocks. Risk management applies to long-term investing as well. Dollar cost average into strong companies and ETFs. The essence of risk management. Risk management is not a rule. It's a lifestyle. It's how you think, react, and protect yourself. When you master risk, everything else becomes easier. Chapter 9. Trade Analysis and Option Strategy. A professional framework for reading price action, analyzing setups, and executing options trades with precision. Trading is not about predicting the future, it's about reading the present. Your edge comes from understanding context, recognizing patterns, and executing with discipline. This chapter teaches you how to analyze price action, interpret volume, understand premium behavior, and build tactical trade plans that align with the market structure. This is where risk management meets execution. 1. Market context and confirmation. Before entering any trade, you must understand the environment you're operating in. Key questions include whether the market is risk-on or risk-off, whether SPY is trending or chopping, and whether volume confirms the move. Your job is to react, not predict. 2. Daily, weekly, and intraday candle behavior. Daily charts reveal oversold or overbought conditions and wick reversals. Weekly charts show major support and resistance wicks. Intraday charts reveal VWAP behavior and volume confirmation. 3. Trend reversals and structure. Price only does 3 things: bounce, reject, or break out. Reversals show through wick rejections, volume shifts, trendline breaks, and engulfing candles. Continuation shows through higher highs, lows, lower highs, lows, and volume alignment. 4. Scenario planning. Before the open, professional traders prepare key levels, pre-market highs, lows, futures direction, expected volatility, and a plus setups before the bell. If you don't write your plan, you won't follow it. 5. SPY SPX tactical execution. SPY SPX require precision. Take partial profits at 1.5 to point intervals. 0-day trade should last 5 to 15 minutes max. Avoid choppy conditions. SPX premiums are often overpriced into the close. Avoid inflated traps. 6. Options premium behavior. Premium tells the truth. Track low and high of the day. Premium often moves in a 1-to-3 ratio. If a contract goes from OTM to ITM into the close, have your sell limit ready. Reversals can happen in seconds. 7. OTM versus ITM logic. Buy OTM only during clear breakouts, breakdowns for quick scalps. Prefer ITM for safer, more stable premium with higher delta and less theta decay. 8. VIX-based strategy selection. Low VIX favors buying premium. High VIX favors selling premium. Memory hook. Low VIX equal to buy. High VIX equal to sell. 9. Credit spreads for consistent income. Credit spreads offer defined risk, defined reward, and theta advantage. Example: sell a put, buy a lower strike put, collect credit, and manage break-even and max loss. 10. Levels, catalysts, and RVOL mark pre-market high-low, previous day high-low, intraday levels, and VWAP. Catalysts include earnings, news, Fed events, sector rotation, and RVOL. High RVOL equal to high opportunity. 11. Building a tactical trade plan. Every trade must have 3 reasons for entering: a take-profit target, a hedge, an invalidation level, position size, and an exit plan. If you can't explain the trade, don't take it. 12. The psychology of execution. Your impulses are your biggest enemy. Avoid greed, hesitation, hope, and revenge trading. Take what the market gives. Trade the chart, not your emotions. The essence of trade analysis. Trade analysis is about reading the present with clarity. When you combine structure, confirmation, volume, trend, premium behavior, and discipline, you become a tactical professional trader. AI can assist with analyzing charts. Just ask ChatGPT, Pilot, or Gemini for trend direction, key levels, candlestick behavior, volume patterns, indicators, breakouts, breakdowns, or fakeouts, gaps, wicks, liquidity zones, trend and structure. Is price respecting a trend line or breaking structure? 104. Where is the most recent higher high or lower low? Is this a trend continuation or reversal setup? Levels and liquidity. What price levels have the strongest reactions? Where are liquidity grabs likely to occur? Is price approaching a major supply or demand zone? Momentum and indicators. Is RSI showing divergence with price? Is volume confirming the move? Are EMAs stacked bullish or bearish? Risk and trade planning. Where is the safest stop-loss placement based on structure? What invalidates this setup? What's the risk to reward if entering at this level? Market context. Does this move align with ESNQ futures? Is this breakout supported by broader market strength? 106. Chapter 10. Patience is key. Patience is one of the most underrated skills in trading. Most traders think the goal is to trade more. Professionals know the goal is to trade better. Sometimes the best trade you can take is the one you don't take. The market will be here tomorrow, next week, and next year. But you might not if you rush, chase, or force trades that don't align with your edge. Patience protects your capital, your psychology, and your future. The market will always give another opportunity. The market is always moving. There will always be another setup, another breakout, another trend, another reversal. Missing a trade is not a failure. It's a sign that you're respecting your process. Don't regret the trades you didn't take. Don't chase moves that already happened. Don't force entries because you're bored. Allow the market to come to you. Chasing is emotional. Waiting is professional. Set your alerts. Mark your levels. Respect your trading window. If no clean setup forms, you don't trade. Markets fall fast and rise slowly. Your job is to stay patient enough to catch the move, not predict it. Trade safer. ITM contracts and futures with time. When you're building consistency, you want stability, not adrenaline. ITM contracts move cleaner. Futures with time reduce stress. You avoid theta decay traps. You give your thesis room to work. Patience isn't just emotional, it's strategic. Time in the market beats timing the market. Trying to catch the exact top or bottom is a rookie mindset. Professionals focus on trend, confirmation, and risk. Small, consistent gains compound faster than you think. A trader who grows slowly grows safely. Have realistic expectations. Consistency doesn't come on a schedule. You can't force mastery. Your only job is to find your edge, master your process, stay patient, and stay disciplined. The results follow the behavior, not the other way around. Surround yourself with successful mentors. You can go solo, but it will cost you time, money, and emotional energy. The right guidance shortens your learning curve, helps you avoid traps, gives you structure, and builds confidence. Invest in education. Your future self will thank you. Trading is a business. Build a plan. Trading is not a hobby. It's not gambling. It's a business. Build a plan around your methodology, confirmations, risk management, and execution rules. A business without a plan fails. A trader without a plan blows up. Everyone takes losses. Losses are not a sign of failure. They are a cost of doing business. When you manage risk properly, losses become small. Wins become meaningful. Emotions stay controlled, and your account grows steadily. Patience helps you avoid unnecessary losses. Discipline helps you survive the inevitable ones. The essence of patience. Patience is not passive. Patience is a skill. Patience is a weapon. It's the ability to wait for your setup, trust your plan, ignore noise, avoid FOMO, protect your capital, and trade only when your edge is present. When you master patience, You stop chasing the market, and the market starts rewarding you. What not to do. Don't short support without confirmation. Don't trade size in low momentum. Chapter 11: Self-Awareness and Trading Psychology. Self-awareness is the foundation of emotional control. Emotional control is the foundation of consistency. Consistency is the foundation of profitability. This chapter teaches traders how to understand their own minds so they can trade with clarity, confidence, and discipline. Be aware in the moment. Self-awareness begins the moment you sit down to trade. You must recognize when you're distracted, emotional, forcing trades, trading from fear, or trading from ego. Ask yourself, what state of mind am I in right now? Your emotions are signals, not commands. Emotions will always show up. The key is not eliminating them. It's not obeying them. Fear makes you hesitate. Greed makes you overstay. FOMO makes you chase. Anger makes you revenge trade. Anxiety makes you exit too early. Self-awareness allows you to see the emotion without becoming it. The past has nothing to do with the present. One of the biggest psychological traps in trading is letting past trades influence current decisions. A past loss makes you fearful. A past win makes you overconfident. A past mistake makes you hesitant. But the market doesn't care about your past. Only you do. Take screenshots of bad trades. Bad trades are your greatest teachers, but only if you study them. Create a journal filled with screenshots of your worst trades, notes on what you felt, what you ignored, and what you should have done. Reviewing mistakes builds self-awareness faster than any course. Avoid overtrading and market hypnosis. When you stare at charts too long, your brain starts inventing setups that aren't there. This leads to forcing trades, taking the wrong side, acting on impulse, and getting trapped by market makers. If you feel hypnotized by the screen, step away. Understand market psychology. Sometimes the logical trade is the losing trade, because it's the trade retail traders are expected to take. Market makers prey on obvious breakouts, breakdowns, emotional reactions, and news events already priced in. When in doubt, zoom out, look at key levels, read volume, hedge if necessary, and stay patient. Learn from losing trades without emotional trauma. A losing trade is not a personal failure. It's data. Emotional traders turn losses into fear, hesitation, trauma, and self-doubt. You must separate the event from the emotion. The next trade has nothing to do with the last one. Trade in the now. Most traders live in the past or the future. But the only thing that matters is what the market is telling you right now. Trading in the now means reacting to price and volume, staying mindful of your thoughts, and making decisions based on reality, not fear. Break bad habits and build good ones. Your habits determine your success. Bad habits cost you money. Good habits make you consistent. Successful traders share traits like passion, persistence, self-discipline, a desire to improve, and a commitment to learning. Fixing FOMO. Before entering any trade, ask, what is my risk to reward? If you can't answer that, you're not trading, you're gambling. FOMO disappears when you know your edge, trust your plan, and accept that missing a trade is fine. Finding your zone. Trading requires a unique mental state, dealing with losses daily, accepting imperfection, and staying calm under pressure. Your new comfort zone is discomfort. Your new strength is adaptability. Control your environment. 90% of trading success is emotional, not intellectual. Control your environment, reduce distractions, keep your workspace clean, maintain a trading schedule, and avoid screens when no setups exist. Mental health matters. Trading is stressful. Long-term stress becomes dangerous. Protect your mind, meditate, exercise, eat clean, sleep well, maintain balance, and seek support when needed. A healthy mind makes better decisions. The essence of self-awareness. Self-awareness is the ability to observe your thoughts, recognize your emotions, understand your patterns, break destructive habits. Stay present, stay disciplined, and stay patient. When you master yourself, you master your trading. Chapter 12: Self-Awareness, the trader's inner mirror. Self-awareness is the trader's first real edge. Not indicators, not chart patterns, not strategies. It's the ability to recognize your own thoughts, emotions, impulses, and behaviors in real time, and to act with discipline instead of instinct. Most traders lose not because they lack skill, but because they lack awareness of what's happening inside them while they trade. This chapter teaches you how to see yourself clearly so you can trade with clarity. Be present when you trade. Self-awareness begins the moment you sit down at your desk. You must be able to notice when your mind is scattered, when you're rushing, when you're emotional, when you're about to do something impulsive, and when you're trading from fear instead of logic. Ask yourself, am I fully here right now? Discipline, focus, and confidence without fear. A self-aware trader knows how to maintain discipline, focus, confidence, and emotional neutrality. Fear has no place in execution. Confidence doesn't mean arrogance. It means trusting your plan more than your emotions. Remove emotion from trading. Emotions are natural. Acting on them is optional. Self-awareness helps you take profits without greed, cut losers without hesitation, and follow your plan without emotional interference. Your job is not to feel nothing, it's to not let feelings make your decisions. Know your emotional triggers. Every trader has patterns. Fear after a big loss, overconfidence after a big win, hesitation after missing a move, impulse after boredom, revenge after frustration. Self-awareness helps you catch these patterns before they cost you money. Study your mistakes. Bad trades are your greatest teachers. If you study them, take screenshots, write notes, record what you felt, record what you ignored, and record what you should have done. A journal full of mistakes becomes a roadmap to consistency. Screen time builds skill, but avoiding bad trades builds profit. Anyone can learn to spot good setups. Professionals learn to avoid bad ones. Self-awareness helps you recognize when you're forcing a trade. Notice when you're trading out of boredom. Identify when you're mentally fatigued and step away when you're not sharp. Avoiding bad trades is a superpower. Trust the process over profits. Self-aware traders understand that profits are a byproduct. Process is the priority. Consistency comes from behavior, and behavior comes from awareness. You don't chase money, you chase mastery. Avoid market hypnosis. Staring at charts too long can trick your brain into seeing setups that aren't there. This leads to overtrading, taking the wrong side, acting on impulse, and falling for market traps. If you feel hypnotized, step away. Clarity is more valuable than screen time. See the market clearly. Self-awareness helps you interpret key levels, price action, volume, market psychology, and traps. When in doubt, zoom out, slow down, observe, and wait for confirmation. Awareness sharpens your edge. The essence of self-awareness. Self-awareness is the ability to notice your thoughts, recognize your emotions, understand your patterns, catch your impulses. Stay present, stay disciplined, and stay patient. You master yourself, you master your trading. Chapter 13, Trading Psychology 101. Trading is not a battle against the market. It's a battle against your own mind. Your thoughts, emotions, impulses, and beliefs shape every decision you make. Most traders lose not because they lack skill, but because they lack psychological control. This chapter teaches you how to understand the emotional patterns that influence your trading, how to break destructive cycles, and how to build the mental resilience required to trade with clarity. The market is not your enemy. Your mind is. The market doesn't care about your expectations, fears, past trades, goals, or needs. It simply reflects supply and demand. Your mind, however, reacts to fear of losing, fear of missing out, fear of being wrong, fear of repeating past mistakes, and fear of not making enough. Understanding these reactions is the foundation of trading psychology. Why the logical trade is often the losing trade. Retail traders often take the trade that looks obvious, clean breakouts, perfect breakdowns, straightforward news reactions, or trends that feel safe. But the market is forward-looking. News is often priced in. Obvious setups are often traps. Market makers exploit predictable retail behavior. Self-awareness helps you avoid becoming part of the trap. The past does not define the present. One of the most dangerous psychological habits is letting past trades influence current decisions. A past loss creates hesitation. A past win creates overconfidence. A past mistake creates fear. A past missed opportunity creates FOMO. But the market doesn't remember your past. Only you do. Your job is to trade what's happening now, not what happened yesterday. Fear of entering versus disruptive fear. There are two types of fear. 1. Fear of entering, emotional fear based on past pain. 2. Disruptive fear, rational fear based on weak volume, sloppy price action, or missing confirmation. Self-awareness helps you distinguish between the two. Fixing FOMO. Before entering any trade, ask, what is my risk to reward? If you can't answer that, you're not trading, you're reacting. FOMO disappears when you trust your edge, trust your plan, accept that missing the trade is fine, and understand that chasing destroys accounts. Trade in the now. Most traders live in the past or the future. But the only thing that matters is what the market is telling you right now. Trading in the now means reacting to price and volume, staying mindful of your thoughts, staying aware of your emotional state, and making decisions based on reality, not fear. You create your own stress, the market doesn't. The market psychology trap. Sometimes the best trade is the opposite of what your mind is telling you. Retail traders think alike, react emotionally, chase obvious moves, and get trapped easily. When in doubt, zoom out, look at key levels, read volume, observe the reaction, hedge if necessary. Self-awareness helps you see the trap before you fall into it. Learning from losses without emotional trauma. Losses are inevitable. Emotional trauma is optional. A losing trade is data, feedback, information, and a lesson. Emotional traders turn losses into fear, hesitation, trauma, and self-doubt. The next trade has nothing to do with the last one. The future has nothing to do with the past. Finding your zone. Trading requires a unique mental state, dealing with losses daily, accepting imperfection, embracing uncertainty, and staying calm under pressure. Your new comfort zone is discomfort. Your new strength is adaptability. Your new advantage is emotional neutrality. The essence of trading psychology. Trading psychology is the ability to understand your emotions, recognize your patterns, break destructive habits, stay present, stay disciplined, stay patient, and stay objective. When you master your psychology, you master your trading. Chapter 14, Mastering Habits, Discipline, and the Trader's Lifestyle. Trading is not just a skill, it's a lifestyle. Your habits, routines, environment, and discipline determine your results far more than any strategy or indicator. Most traders fail not because they lack knowledge, but because they lack structure. This chapter teaches you how to build the habits and lifestyle that support consistent, disciplined, long-term trading success. Break bad habits before they break you. Your habits shape your trading outcomes. Bad habits make you emotional, cause impulsive trades, lead to oversized positions, create inconsistency, and drain your confidence. Good habits keep you disciplined, protect your capital, strengthen your psychology, build consistency, and create long-term growth. The longer you wait to fix bad habits, the longer you delay becoming a profitable trader. Control your environment. Your environment influences your decisions more than you realize. A clean, organized, distraction-free workspace helps you think clearly. Stay focused. Avoid emotional. Stick to your end trades. Plan. Maintain discipline. 90% of trading success is emotional, not intellectual. Your environment shapes your emotions. The qualities of successful traders. Consistently profitable traders share the same traits: passion, persistence, self-discipline, a desire to improve, and a commitment to learning. These qualities aren't natural. They're built through repetition, reflection, and self-awareness. Build a trading schedule. You don't need to sit in front of the screen all day. In fact, doing so often leads to overtrading, fatigue, emotional decisions, and forced setups. A professional trader knows when to trade, when to stop, and when to walk away. A 2 to 4 hour focused window is more profitable than 10 hours of emotional screen staring. Know when to stop trading. Once you hit your profit target, stop seeing clean setups, feel mentally fatigued, or start forcing trades. You stop trading. Trying to squeeze every dollar out of the market is how traders give back their gains. Accept losses quickly. Losses are part of the game. Your job is to cut them fast, keep them small, and move on without emotion. A small loss is a business expense. A large loss is a threat to your future. Handle choppy days with discipline. On choppy days, use tight stops, take quick scalps, avoid oversized positions, don't expect follow-through, and don't force trends that aren't there. Chop destroys emotional traders. Discipline. Traders survive it. The trader's lifestyle. Trading is not just charts, it's life. To perform at your best, meditate, exercise, eat clean, Sleep well, maintain balance, and protect your mental health. A healthy mind makes better decisions. A healthy body supports a healthy mind. Risk and success go hand in hand. Trading requires courage, confidence, calculated risk, and emotional neutrality. Risk-taking should be calm, collected, and strategic, never emotional. The power of compound interest. Small gains add up fast. Even 5% a day becomes 25% a week, 100% plus a month, and 1,200% plus a year. This doesn't require hero trades. It requires patience, discipline, consistency, and risk management. Rome wasn't built in a day, and neither is a trading account. The essence of habits and discipline. Mastering trading means mastering your routines, your behavior, your environment, your emotional patterns, your discipline, and your patience. You don't decide your success. You decide your habits, and your habits decide your success. Chapter 15, Trading Styles. Systematic versus discretionary. There are only two ways to trade the markets, systematic or discretionary. Every trader falls somewhere along this spectrum. The key is not choosing the right style. It's choosing the style that aligns with your psychology, strengths, and long-term goals. This chapter breaks down both approaches with clarity, honesty, and strategic depth. You'll learn how each style works, how intuition is built, how rules evolve, and how to blend structure with flexibility to create your own edge. The two ways to trade. Trading is simple in theory but complex in execution. At the highest level, every trader operates in one of two ways, systematic or discretionary. Both are valid. Both can be profitable. Both require discipline. The difference lies in how decisions are made. Systematic traders build a set of rules and only take trades when the market meets those criteria. Their edge comes from consistency, structure, and repeatability. They follow predefined rules, rely on backtesting, remove emotion from decisions, trade the same setups repeatedly, and thrive in structured environments. Creating a fully systematic strategy is difficult because markets are driven by thousands of participants with different motives, liquidity shifts, and evolving behavior. This is why most traders eventually blend rules with discretion. Pure systems rarely survive long-term without adaptation. Discretionary traders rely on intuition, pattern recognition, and experience. They don't wait for a rigid checklist. They react to what the market is showing them right now. They adapt to changing conditions, rely on implicit memory, trade based on feel, vary their setups day to day, and thrive in dynamic environments. Intuition is not guessing, it's implicit memory built through screen time, repetition, reviewing trades, studying price action, and watching how markets react. This is why discretionary trading looks like guessing to outsiders. They can't see the thousands of micro patterns your brain has stored. The hybrid approach. Most successful traders are neither fully systematic nor fully discretionary. They operate in the middle. Rules create structure. Discretion creates adaptability. This hybrid approach gives you consistency, flexibility, emotional control, strategic clarity, and the ability to evolve with the market. Your rules keep you disciplined. Your discretion keeps you profitable. Marking levels. The foundation of all trading, regardless of style. Every trader must understand levels. A simple but powerful technique. Mark the previous day's high, low, open, close, body top, and body bottom. These become your support and resistance zones for the next day. This is how you build context, the most underrated skill in trading. The role of context. Context answers the most important question. What type of market am I trading right now? Trending, ranging, choppy, volatile, slow, or news-driven? Your strategy must match the environment. A great setup in the wrong context becomes a losing trade. The trader's identity. Before you can master the market, you must master yourself. Ask yourself, do I thrive with structure or flexibility? Do I prefer rules or intuition? Do I enjoy fast decisions or slow analysis? Do I want to trade all day or only during key windows? Do I handle uncertainty well? Your trading style must match your personality, not someone else's. The motivational truth: you don't need to be perfect. You don't need to predict the future. You don't need to catch every move. You only need a repeatable edge, a disciplined process, a style that fits you, and a mindset built for uncertainty. Trading is not about being right, it's about being consistent. The strategic takeaway. Systematic traders win through structure. Discretionary traders win through adaptability. Hybrid traders win through balance. Your job is to understand both. Choose your lane, build your edge, refine your process. Stay disciplined, stay flexible, and stay committed. This chapter sets the foundation. The next chapters build the blueprint, rules, and tactical execution that turn this foundation into a complete trading system. Chapter 16, Building a Professional Trading Plan. Most traders lose because they trade without a plan. They enter randomly. They exit emotionally. They size impulsively. They react instead of execute. A professional trading plan eliminates chaos. It gives you structure, clarity, and confidence. It turns trading from gambling into a business. This chapter teaches you how to build a complete, professional-grade trading plan, the same type used by disciplined traders, prop firms, and high-level operators. The purpose of a trading plan. The trading plan answers 3 questions. What will I trade? How will I trade it? How will I protect myself? Without these answers, every trade is a mistake because every trade is random. A trading plan is not optional. It is the foundation of consistency. The core elements of a professional trading plan. 1. Your market and time frame. Define what markets you trade, what instruments you trade, what time frames you use, and when you trade. If you don't define your battlefield, you can't win the war. 2. Your entry criteria. Every entry must have a reason, a trigger, a confirmation, and a context. If you can't explain why you're entering, you shouldn't be entering. 3. Your exit criteria. Professionals obsess over exits. Define your profit target, stop loss, trailing stop rules, early exit conditions, and scaling rules. You should know your exit before you enter. 4. Position sizing. This is where most traders blow up. Define max size per trade, max capital per position, max daily loss, max weekly loss, and max number of trades per day. If you don't control size, size will control you. 5. Risk management rules. Risk management is not about avoiding losses, it's about surviving them. Define daily, weekly, and monthly stops, max, drawdown, when to stop, trading, when to reduce size, and when to increase size. 6. Market conditions. Define when you trade, when you avoid trading, and how you adapt to conditions. Context. Determine strategy. 7. Event rules. Define whether you hold through earnings, news, overnight, or weekends. If you don't define this, emotions will define it for you. 8. Trade discovery. Define how you find trades, scanner, watch list, same instrument daily, manual charting, volume spikes, or key levels. Your plan must define your process, not your hope. 9. Review process. Professionals review. Amateurs repeat mistakes. Include daily, weekly, and monthly reviews, screenshot journaling, mistake tracking, and performance metrics. Reviewing is how you evolve. 10. Mistake tracking. A. Mistake is anything not aligned with your plan. Track what mistake you made, why you made it, how much it costs, how often it happens, and how you will fix it. Fix one mistake at a time. 11. Goals and objectives. Define income versus growth, part-time versus full-time, independent versus firm, work-life balance, monthly savings, and tax planning. Trading is a business. Treat it like one. The motivational truth of trading plan is not a document, it's a commitment. It says, I will trade with discipline. I will protect my capital. I will follow my rules. I will improve every day. I will treat trading like a profession. Your plan is your identity. Your identity shapes your results. The strategic takeaway. A professional trading plan gives you structure, clarity, confidence, consistency, discipline, and longevity. Without a plan, you're gambling. With a plan, you're building a career. This chapter gives you the blueprint. The next chapter will give you the rules, the mistakes, and the probabilistic mindset that turn this blueprint into a powerful trading system. Chapter 17, Rules, Mistakes, and Probabilistic Thinking. Most traders don't fail because of strategy. They fail because of behavior. They fail because they break rules, repeat mistakes, and think in terms of certainty instead of probability. This chapter teaches you how to eliminate destructive habits, build a disciplined rule set, and adopt the probabilistic mindset required to trade like a professional. The purpose of rules exist for one reason: to protect you from yourself. The market is not your enemy, your impulses are. Rules create structure. Structure creates discipline. Discipline creates consistency. Without rules, every trade becomes a gamble. With rules, every trade becomes a business decision. The 24 core trading rules: 1. Trade only liquid stocks. 2. If your stop loss keeps getting hit, stop trading. 3. Never revenge trade. 4. If you hit your weekly target on the first trade, stop trading. 5. Never trade without a stop loss, and never move it. 6. Never average down into a losing trade. 7. Never take a trade without a signal. 8. Only take trades that meet all your criteria. 9. Risk reward must be 1 to 1, 5, or better. 10. Never put all your capital into one trade. 11. Never trade with money you can't afford to lose. 12. Never borrow money to trade. 13. Don't be greedy. 14. Don't overload your chart with indicators. 15. Don't follow random signals or alerts. 16. Backtest your strategy before risking money. 17. Don't trade too many tickers at once. 18. Avoid OTM contracts as a beginner. 19. As a beginner, take only one trade per day for a month. 20. Protect capital before chasing profits. 21. Cut losers fast. Ride winners with structure. 22. Keep bets small. 23. Avoid choppy markets. 24. Avoid stocks in the news. The probabilistic mindset: to think like a professional trader. You must accept 5 truths. Anything can happen. You don't need to know what happens next to make money. Wins and losses are randomly distributed. An edge is a probability, not a guarantee. Every moment in the market is unique. When you internalize these truths, you stop trying to predict and start executing. The consistent winner belief system. A consistent winner believes, I objectively identify my edges. I predefine the risk of every trade. I fully accept the risk before entering. I act on my edges without hesitation. I pay myself when the market offers profit. I monitor my susceptibility to errors. I never violate the principles of consistency. The cost of mistakes. A mistake is anything not aligned with your plan. Entering too early, entering too late, exiting too early, exiting too late, oversizing, trading in the wrong conditions, ignoring your stop, trading while emotional, taking random trades, following someone else's call, expanding your stop, trading while tired, trading without a routine. Each mistake has a dollar cost. Track it, and you'll be shocked. The mistake tracking method. 1. Track every mistake for 30 days. 2. Identify your most common mistake. 3. Focus on fixing one mistake at a time. 4. Review it daily before trading. 5. Track your progress weekly. 6. Once fixed, move to the next mistake. The motivational truth. You don't need more indicators. You don't need more strategies. You don't need more predictions. You need fewer mistakes, better discipline, stronger rules, a probabilistic mindset, and a consistent process. The strategic takeaway: rules protect you. Mistakes teach you. Probability guides you. Discipline defines you. This chapter is the bridge between your trading plan and your execution. The next chapter will take you into the tactical world, the real-time strategies, options logic, and execution techniques that bring everything together. Chapter 18, Tactical Execution and Option Strategy. This is the chapter where everything becomes real, not theory, not concepts, not mindset, execution. Trading is a performance skill. You can have the best plan, the best rules, and the best psychology, but if you can't execute tactically, you will never unlock your full potential. This chapter gives you the tactical edge: how to read premium behavior, how to scalp in choppy markets, how to trade momentum, how to use directional bias, how to read tape and volume, how to use VIX to your advantage, how to trade like a SPX spy sniper, how to avoid premium, decay traps, and how to build a tactical plan before the bell. The foundation of tactical execution: before you place a trade, you must know conditions, entry, stop, target, the CEST framework. If you can't define all 4, You're not trading, you're guessing. Premium behavior, the hidden language of options. Options premium tells the truth even when price action lies. Premium rises fastest when momentum is strong, collapses instantly when momentum dies, decays fastest in OTM contracts, holds value better in ITM contracts, and often moves in 1-to-3 ratios intraday. Premium is a sentiment indicator. It shows whether the market believes in the move. The 6-strike rule counts 6 ITM strikes from the previous close. These contracts move cleaner, hold value better, are less manipulated, and are ideal for scalping. Wait for premium to cool before entering. Never chase inflated premium. The end-of-day premium rule. Into the close. If your OTM contract goes ITM, take profit immediately. Reversals happen in seconds. Have sell limits ready. End-of-day premium is ruthless. It rewards discipline and punishes greed. Directional bias. Directional bias keeps you on the right side of the train. Green on the day plus above VWAP equal to long bias. Red on the day plus below VWAP equal to short bias. Bias doesn't mean prediction, it means alignment. The gap strategy, gap and go versus gap and crap at the open, the market will either continue or reverse. Use the first 10 minutes to identify which one you're dealing with. The 10-minute hack at 10 minutes after open. Set buy to open limit orders for both calls and puts near ATM with a small premium. Let market choose the direction. Scalping in choppy markets. Chop destroys emotional traders. Professionals survive it by using tight stops, taking quick profits, trading only at key levels, avoiding mid-range entries, reducing size, and trading less. In chop, buy support, short resistance, take profit fast. Momentum trading OTM contracts are only acceptable when momentum is strong, volume is high, and breakdowns are clean. Momentum is your friend until it isn't. The VIX playbook: low VIX equal to buy, high VIX equal to sell. Tape reading. Tape reading reveals who is in control, whether momentum is real, whether a breakout is fake, and whether a reversal is coming. Show history, charts. Tape shows intention. Strategic notes only trade significant levels. Pre-calculate premium entries, exits. Build scenarios before the bell. Trade as if you only have $100. Track premium behavior. Don't get stuck in one trade all day. SPX end-of-day rule. Only buy contracts worth $5,000 plus at the high of the day. Crypto DCA. Buy support only. Market cycles. Plus gamma stable, gamma volatile. Witching. After quad, expect a new cycle. The motivational truth: execution is where traders are made. You don't need perfection, you need consistency. Execution is a skill built through repetition, review, adjustment, awareness, and discipline. The strategic takeaway: this chapter gives you the tactical edge, how to read premium, scalp, trade momentum, use directional bias, read tape, plan before the bell, and execute like a professional. This is the chapter traders will return to again and again. Chapter 19, the law of propensity and the trader's mindset. Trading is not just a skill. It's not just a strategy. It's not just charts, indicators, or price action. Trading is a mirror. It reflects your beliefs, your discipline, your emotional patterns, and your internal state. The market exposes everything you haven't mastered within yourself. This chapter is about the inner game, the law of propensity, the psychology of execution, the discipline of consistency, and the mental frameworks that separate professionals from everyone else. The law of propensity. What you focus on expands. Most traders focus on the wrong thing: the money, the outcome, the PL, the fear of losing, the desire to win fast. But the law of propensity teaches something different. Don't focus on the money. Focus on what you need to learn. Focus on who you must become. Your results are a reflection of your internal state. If your mind is chaotic, your trading will be chaotic. If your mind is disciplined, your trading will be disciplined. If your mind is fearful, your trading will be hesitant. If your mind is clear, your trading will be precise. Your mind is a magnet. Your thoughts are signals. Your emotional state is your trading environment. Marginal propensity to save and why it matters. To traders economically, marginal propensity to save measures how much of new income you save. But psychologically, it teaches a deeper lesson. Small changes in behavior create massive changes in outcome. A tiny improvement in discipline, patience, emotional control, execution, or risk management compounds into exponential growth over time. Trading rewards the trader who improves 1% at a time. The 3 pillars of the trader's mindset. 1. Risk management, not just numbers, but identity. A professional sees risk as oxygen, not fear. 2. Presence, bringing your mind into the moment of trading. No past losses, no future fantasies. 3. Trading psychology, patience, emotional neutrality, non-attachment, and the ability to act without hesitation when your signal triggers. There will always be another trade. There will not always be another account. Your mind is a magnet. Your thoughts shape your trading reality. Think fear. Elite traders share a specific psychological profile: passion for markets, systematic problem solving, technical skill, strategic decision making, resilience. You trade scared. Think greed, you chase. Think doubt, you hesitate. Think clarity, you execute. Think abundance, you grow. Positive thoughts don't guarantee profits, but negative thoughts guarantee mistakes. Cultivate calm, clarity, confidence, gratitude, and focus. These states sharpen your edge more than any indicator. The traits of a high-level trader: intellectual curiosity, ownership, integrity, and ability to think quantitatively, comfort with uncertainty, ability to identify inefficiencies, and the ability to act quickly and decisively. These traits are not innate, they are trained. The 6 steps to attracting what you want. 1. Calm your nervous system. 2. Ask your soul what it truly wants. 3. Focus on your intention. 4. Imagine the feeling of it happening. 5. Let go of expectations. 6. Dwell in gratitude. This is emotional regulation, the foundation of elite execution. Desire plus certainty equal to alignment. Whatever you desire: freedom, mastery, wealth, confidence, control, growth. You must be clear, certain, and intentional. Say, I accept and I am worthy of all I desire. Imagine how achieving it will elevate your life and the lives of those you love. Lock that feeling into your body. Act only on decisions aligned with that feeling. This is how you build identity-based discipline. Flawless execution. Flawless execution does not mean buying the bottom or selling the top. It means trading the chart, following the plan, and acting without hesitation. Terrible execution means your emotions are doing the trading. You don't need perfect entries, you need consistent behavior. The danger of trying to make money fast, trying to extract money quickly, creates urgency, fear, greed, impulsiveness, overtrading, and oversized positions. Small, consistent gains build accounts. Rush gains destroy them. Patience is 172. A strategy. Discipline is a weapon. Consistency is the edge. Discipline. The foundation of all success. Discipline is not punishment, it is self-respect. It means following your rules, controlling your impulses, regulating your emotions, honoring your plan, and choosing long-term growth over short-term excitement. Self-discipline is the highest form of self-love. How professionals think. Professionals plan their trades, define risk in advance, execute without hesitation, accept losses instantly, avoid unrealistic expectations, never let winners turn into losers, never let losers turn into disasters, and move in and out of trades with ease. They don't need to know what happens next, only how they will respond. The components of consistency. Consistency comes from a trading plan: risk parameters, position sizing, profit objectives, emotional neutrality, and realistic expectations. Being wrong is part of the game. Losing is part of the game. Missing out is part of the game. Leaving money on the table is part of the game. Professionals accept this. Amateurs fight it. The strategic takeaway. The law of propensity teaches: you attract what you are prepared for, you receive what you are aligned with, and you achieve what you are disciplined enough to execute. This chapter builds the internal foundation required to trade like a professional. Chapter 20: Market Mechanics, Supply and Demand, and Professional Behavior. Most traders think the market is random. Professionals know it's structured. Most traders think price moves because of indicators. Professionals know price moves because of behavior, liquidity, incentives, and imbalance. Most traders think trading is about predicting. Professionals know trading is about responding. This chapter takes you inside the real mechanics of the market, the forces that shape price, the behaviors that drive movement, and the mindset required to operate like a professional. The law of supply and demand, the engine of all price movement, every candle, every breakout, every reversal, every trend, all of it comes down to one thing: supply versus demand. When demand exceeds supply, price rises. When supply exceeds demand, price falls. When both are balanced, price consolidates. This is the foundation of price discovery. The equilibrium point: supply and demand curves intersect at the market clearing price, the level where buyers and sellers agree. This is why price often stalls at key levels: previous highs, previous lows, VWAP, liquidity pools, and psychological levels. These are areas where supply and demand temporarily balance before the next imbalance forms. Professionals don't trade indicators, they trade imbalances. Pricing inefficiencies. Where professionals make money, markets are not perfectly efficient. They are full of delays, emotional reactions, liquidity gaps, mispricings, overreactions, and underreactions. Professionals identify these inefficiencies and monetize them. Examples: a stock overreacts to news, fade the move. A breakout forms on low volume, short the trap. A liquidity grab, sweet stops, enter the reversal. A trend pulls back to demand, buy the dip. Your job is not to predict the future. Your job is to recognize inefficiency and act decisively. The traits of elite traders. Professional traders share a specific set of traits that allow them to operate in uncertainty: passion for markets, systematic problem solving, ability to think quantitatively, comfort with uncertainty, fast decision making, emotional resilience, intellectual curiosity, ownership and integrity, ability to identify inefficiencies, ability to transform data into signals. These traits are not innate, they are trained. Futures. Why professionals love them: futures offer advantages that stocks and options simply can't match. No PDT rule. Trade with a few $100s. Superior platforms. 60/40 tax rule. Choose your exposure. High liquidity. Tiny spreads. Nearly 24/6 trading. Instant settlement. Futures are built for traders who want flexibility, leverage, liquidity, speed, precision. They are the purest form of price action. Treasury auctions, the hidden force behind market moves. Most retail traders don't understand how deeply treasury auctions affect the stock market. When the government auctions bonds, yields move, the yield curve shifts, risk sentiment changes, liquidity adjusts, futures react, equities follow. A weak auction, yields rise, stocks often drop. A strong auction, yields fall, stocks often rise. Within 15 minutes of an auction, futures spike, volatility increases, volume surges. Professionals watch auctions. Amateurs don't even know they exist. Macro for traders: inflation, stagflation, and CPI. You don't need to be an economist to trade, but you must understand macro forces. Inflation: prices rise, purchasing power falls. Stagflation: slow growth plus high unemployment plus inflation. CPI measures inflation, major market mover. Professionals prepare for macro events. Amateurs get blindsided by them. The professional mindset: how pros think. Professionals operate differently. They define risk before entering, accept losses instantly, execute without hesitation, avoid unrealistic expectations, never let winners turn into losers, never let losers turn into disasters, move in and out of trades with ease. They don't need to know what happens next, they only need to know how they will respond. The most common trading errors. Professionals have evolved beyond these mistakes: not defining risk, refusing to take a loss, letting winners turn into losers, moving stops closer and getting wicked out, oversizing, trading emotionally, chasing, hesitating, overtrading, and having unrealistic expectations. These errors destroy accounts. Eliminating them builds consistency. The components of consistency. Consistency is not luck, it is structure. Professionals build consistency through a trading plan, risk parameters, position sizing, profit objectives, emotional neutrality, and realistic expectations. Consistency is not about winning every trade. It's about behaving the same way every time. The strategic takeaway: market mechanics shape price. Supply and demand drive movement. Macro forces influence sentiment. Professional behavior determines longevity. This chapter gives you the external framework, the forces outside yourself that shape the market. Chapter 21, Options, Indicators and Market Terminology. A professional level. This chapter gives you the reference foundation, the definitions, concepts, and indicators that support your strategy, psychology, and execution. Trading is a performance skill, but it's also a language. If you don't understand the vocabulary, the mechanics, and the tools, you can't operate at. Section 1, Options, the foundation. Option types: call, the right to buy the underlying at a specific price. Put, the right to sell the underlying at a specific price. Contract structure: notional contract size. One options contract typically controls 100 shares. Contract multiplier, usually 100 for equity options. Underlying asset: stock. Options derive value from the stock's price. Index tracks a basket of assets. Index options are cash settled. Expiration date, when the contract ends. Leaps, long-dated options. Moneyness: strike price, the price at which the option can be exercised. At the money, strike current price. In the money, calls, price above strike. Puts, price below strike. Out of the money, calls, price below strike. Puts, price above strike. Premium, the price of the option. Intrinsic value, the real value. Time value, extra value based on time until expiration. Premium equal to intrinsic value plus time value. The Greeks: delta, price change per $1 move in the underlying. Gamma, rate of change of delta. Theta, time decay. Vega, sensitivity to implied volatility. Section 2, Market sentiment and behavior. Bullish, expecting price to rise. Expecting price to bearish fall. Sentiment, the emotional tone of the market. Short squeeze, shorts forced to cover as price spikes. Pump and dump, artificially inflating price to sell at a profit. Rug pull, sudden withdrawal of liquidity. FUD, fear, uncertainty, doubt. FOMO, fear of missing out. Section 3, Market terminology. Buy, entering a long position. Sell, exiting or shorting. Bid, what buyers are willing to pay. Ask, what sellers want. Spread, difference between bid and ask. Bull market, rising prices. Bear market, falling prices. Volatility, speed and magnitude of price movement. Limit order, executes at chosen price. Market order, executes immediately. Day order, expires at the end of the day. Going long, betting that the price will rise. Averaging down, buying more as the price falls. Capitalization, market value of a company. Float, shares available for trading. IPO, initial public offering. Secondary offering, additional shares sold later. Portfolio, collection of investments. Borrowed money used margin to trade. Stock split, increasing the share count without changing the total value. Section 4, Technical indicators. Trend indicators: moving average, smooths the price to show the trend. Exponential moving average, more weight is given to recent data. MAC, measures momentum via moving averages. Oscillators: RSI, overbought above 70, oversold below 30. Stochastic oscillator compares the closing price to the recent range. Measures deviation from CCI, the average price. Volatility indicators: Bollinger Bands, expand, contract with volatility. ATR, measures the average range of price movement. Support resistance indicators: pivot points, key levels based on the previous day's high, low, close. Donchian channels, highest high, lowest low over a period. Section 5, how to use indicators properly. Never use an indicator in isolation. Never overload your chart. Always confirm signals with price action. Always follow your trading plan. Indicators support decisions, they don't replace them. Section 6, macro concepts. Every trader must know inflation. Prices rise. Purchasing power falls. Stagflation, high inflation plus slow growth plus high CPI unemployment. Measures inflation, major market mover. The strategic takeaway: this chapter is your reference guide, the technical foundation that supports your strategy, psychology, and execution. You now have options fundamentals, Greeks, market terminology, technical indicators, macro concepts, and sentiment definitions. This is the chapter traders will return to again and again. Conclusion. Reread and study these rules. Remember these rules. Follow the rules. If you have to read them every morning, do so. These are notes collected over time from my experience trading. Not every strategy will work every time. Every day will be different. But these rules give your trading an edge. You must determine when the appropriate time is to apply them and profit. It has to make sense. I hope this book will help save traders money and be of assistance in gaining profits so everyone can achieve their dreams and goals, and finally be able to build generational wealth and cop their win Lambos, yachts, mansions, and penthouses. Always remain motivated, humble, and dedicated to becoming the best trader you are destined to be. Disclaimer. This book is for educational and informational purposes only. Nothing contained within these pages should be interpreted as financial advice, investment recommendations, or an offer to buy or sell any security, cryptocurrency, derivative, or financial instrument. Trading involves substantial risk, including the potential loss of all capital. Past performance does not guarantee future results. The strategies, examples, and concepts presented reflect the author's personal opinions and experiences and may not be suitable for every trader or investor. Readers are solely responsible for evaluating their own financial decisions and should consult with a licensed financial advisor, tax professional, or other qualified expert before acting on any information provided in this book. The author and publisher assume no responsibility or liability for any losses, damages, or consequences resulting from the use or misuse of the information contained herein. By reading this book, you acknowledge that you participate in financial markets at your own risk. Let's get it and make it happen. Think positive affirmations into existence. At H Straight Cash, Twitter X, TikTok, at One Fly Hustle.